Hello, Dave Boucher here. What I'm going to start with is a leverage buyout I worked on at one of my previous jobs. This model is set up as a one-sheet analysis because the management group, the investment group, that they wanted the entire analysis printed on plotter paper to be hung up so they can take all their notes. So as you can see right here, it's really small because, let's see how far I can go down. I'm just going to go about halfway. It's just all long ways. So this is all a tab based model as opposed to others that I'm going to show that are multi-tab. Well, anyways, to begin, I'm going to start out with what is their Hunt's equity contribution. Their net equity contribution is 5892 winds up being, and that's the difference between the uses of funds minus the sources of funds, and then adding with the no management, the company that we're buying out. That's their option amount, which I'm going to explain in a second. It equals 6540. So when you're looking at what are the return summary based off that number to get at a 5.0 EBITDA exit, well, we got, for a management scenario, for the internal rate of return, we got 66.7. So there's several other scenarios here, but let's focus in on 66.7 because that's the main management based scenario. So how was this 66.7 number gotten? Well, it was over here. You can see assumptions. Let me zoom up to the top. The assumptions, and those have obviously things as goodwill, debt, tax rate, so on and so forth. But what I want to look at besides those base assumptions is the revenue growth estimates. The revenue growth estimates, you have 15% for the next 5 years for the management case, while the upside case you have 20% for the next 5. But at the operating expense as a percent of revenue, it's around 51 to 50, and then the upside case is 45 to 40. So those are a little bit different, as you can see, because they're obviously looking at different values. And you got your your debt assumptions, of course. Now, one of the things with the 5892 number, just to show a little bit how it was come up with, is I have a pro forma capitalization table I created, and what this is showing is it has the equity sponsor group of the 5892 number. That's as a preferred because the commons was the no management, obviously. Well, their options end up being 241. Total amount equals 521. You add that with the 5892 rounded amount. That's how you get the 693 total for what it's going to take to buy them with both. Now, creating the LBO, you also have balance sheet, and you have perform it out a balance sheet with adjustments, and then you also have a 5-year income statement. Let me zoom up to show you. Yeah, see, it's the consolidated income statement. The two things I want to point out on this income statement, this is perform it out the next 5 years, is the EBITDA margin. See how these are all going up 0.5 each year? Now it ends up being as a result of the data. On the growth rate itself, like I showed you earlier, with it being a 15% of revenue, well, the EBITDA margins end up actually being about the same to decreasing. That's based off of the same calculation. So there's a little bit of difference on the income statement, perform it out. Then you also got your cash flow statements, your net working capital, your final working capital statements, and then you got your credit statistics right here. What I want to go over with you on the credit statistics, most importantly, is the you got coverage, fixed charges, so on. But the leverage ratios, see how this total debt divided by EBITDA and the leverage ratio, that ends up going down. But the performance ratio, is the ROIC, ends up going up. And not only going up, it went from 14, as you can see right here, all the way to 37. That's more than doubling. And so that's a really good performance compared to the debt, which is actually good, going down. And one of the things with when you're creating these spreadsheet models, when you're doing debt, if statements have to be put in, and so there's always large if statements that have to be put in. This is a rather small one, but just because debt has several different scenarios when you're dealing with outstanding what ifs. Okay, down here at the exit M&A exit valuation returns, obviously off the IRR we talked about 66.7, we get the value of Hunt common plus preferred at exit, that equals 9820. But the initial contribution is 5892. So when you divide those two numbers together, this is based off the first year, you get 1.7. Perform those out, the same numbers all out for the ROIC, you get it gaining on those numbers. Now, when you look at what all those numbers mean in relation to other scenarios, you see here the management scenario, these numbers I just talked about, but the other scenarios, like especially the upside, is way higher. So as you see, 6, and then almost that's double the management scenario. So you can see that, you know, for the most part, it's a good deal. The other thing is the EBITDA margins. That's another huge. I mean, the EBITDA multiples. Those are another big, huge deal. And you can see that management scenario, it's slowly gaining only from 45 to 58 over the next 5, but the upside scenario is a lot higher. So you can take your conclusions from that. Another scenario that happens a lot is when you're evaluating the health at a company, you get, you know, several sets of data that you can get that to see if you want to put money. This is a totally different. This is not leverage buyout anymore, but this is a potential acquisition based looking at a quick health of a company. So this is what you would start out before you get into all that detail. What you see right here is just the net income, perform it out after 2 years. So you see the next 2 years, it goes a little bit negative. Now you have the balance sheet, perform it out, and so you get your estimated working capital. Estimated working capital ends up being a big negative. So let's value that. Let's see what, come down here and see what that actually gets valued at. So you do a cash flow method. Well, put all the cash flows together real quickly. You can see that that's getting negative. And you put the revenue method, revenue even goes down. And so when you do your beta method, net income method, all the way down to book value, and the book value ends up being the closest, but it's down. So we average those out, averages it to 605, and then a 167 for your negative average. So that, you know, as you can see, this is the health of this company is going down. And then the performa, when you do the performa at a 3-year at a 15% growth rate, just to see if it actually is after 3 years, you see that 15% is still going negative the whole time. But then when you put out the net income shows it going almost double the negative, but not quite. So you end up seeing even your net cash flow going to a negative value. So as a whole, this company looks like it's heading in the wrong direction. Now, other method that I've used a lot is the DCF method, or basically that cash flow method which I was talking to you, on a long range basis. So if you get all the revenues and your depreciation, you can find your growth rate. So the growth rate for this one is 6.50. So for the next 5 years, and multiply at 65.0 on the growth rate minus your capital expenditures to find your future cash flow and your present value cash flows. Because eventually you want to find this number here, the terminal value. To get that terminal value number, you would obviously use the CAPM formula, and then also the equity and debt totals. So you get this WACC. To find the WACC, you divide those percentage values of the equity and debt, and then you put that WACC number over here with the other cash flow numbers, and do some division, do some formulas, as you can see up there, and you finally get the present value, total present value minus the debt to find the sub value. So your total value divided by the shares ends up being 24. So you can compare your 24 with, say, the actual price it's selling for is 40 in the stock market, but then you're at 24, so you're actually selling it a lot higher than what it's worth. So that's just another method. Now, a couple other methods that are quick and simple. There's lots and lots of different methods and lots of different software that you can use to do these type of stuff for, but basically evaluation purposes, for the purpose of evaluation, I also use sales per share, cash flow per share, earnings per share. As you can see here, the average growth rate for the 5 years is this right here, and then the actual numbers, what the current value is, a 23.5 and 3. You multiply that with the growth rate, and you get the expected stock price. So your expected stock price are these right here, but it's currently selling at $76.91, which you can see right here also. So you're selling it at a premium. So your average premium is 23.5%, compared to what the expected is. Anyways, that's the summary for this session. Thank you.